Welcome to Part 2, Insurance, Budgeting, and Debt, Tools for Everyday Management and Long-Term Safety. We will discuss health insurance, health savings accounts, liability insurance, also known as umbrella policies. We will also discuss private mortgage insurance, Dave Ramsay's 7 baby steps, envelope budgeting, and finally, the dirty tricks credit card companies play. Let's begin with healthcare and health insurance. The average cost of a 3-day hospital stay is around $30,000. That's about $10,000 a day. Health insurance for the self-employed can cost between $500 and $2,000 per month, with deductibles ranging from $5,000 to $10,000 per year. Obamacare offers low-cost health insurance for many self-employed. Indian Healthcare provides health insurance for recognized Indian tribes in the United States. Qualifying services can only be utilized at specific facilities. Therefore, supplemental health insurance is recommended. Medicare is health insurance for the elderly. Eligibility begins at age 65, and you are required to go on Medicare at age 65. If you are going to retire early, be sure to plan for health insurance costs. This can be forgotten because it's often embedded in a pay stub from a regular job. Health insurance can protect you from bankruptcy and other crises. Healthcare costs are a top cause of bankruptcy in America. Personal liability insurance, also known as umbrella insurance, is liability insurance that can cover you above and beyond the typical liability insurance on your car or home. This protects you and other people. As your assets and income increases, it is advisable to increase your insurance coverage limits to protect those assets and your income. This can also apply to renters insurance, car insurance, homeowners insurance, and personal liability insurance. Now, a little more about the personal liability insurance, sometimes called umbrella insurance. I realize the following is an unpleasant topic. However, we must discuss it. We do not want to think that we could make a mistake and hurt someone else. But we must face the possibilities. This kind of insurance is important because if you make a disastrous mistake or have an accident that is your fault, this type of insurance will cover above and beyond the normal liability insurance. For example, if a tragic accident happens at your home, or if you're in a car accident, you have a medical episode where an accident is determined to be your fault. The medical costs of the other people can be covered above and beyond traditional insurance. If you do not have enough insurance coverage, the other party could come after your various assets. It's possible that personal liability insurance might protect you in certain cases where you are falsely accused. You should discuss with your insurance company what scenarios their personal liability insurance can cover. Now, I want to tell you about private mortgage insurance. This is often called PMI. PMI protects lenders when borrowers default. This insurance is paid for by the borrower. It is usually built in on your mortgage statement. PMI is usually required when the loan-to-value ratio is higher than 80%. This means if you buy a house and you owe more than 80% of the worth of the house, then the mortgage company will likely require you to pay for private mortgage insurance. After a period of time of making payments, eventually you will owe less than 80% of what the home is worth. When this happens, you can call your mortgage company and have the PMI removed. Many people are unaware they can have PMI removed as the mortgage balance is paid down. Next, let's talk about health savings accounts. These accounts are wonderful opportunities to save money tax-free. The money that you put in is tax-deductible, and the money can grow tax-free and be withdrawn tax-free. No other account in America has these combined features. However, there are requirements. Not everyone can qualify for an HSA. You have to be on a high deductible plan, no other health coverage, and you cannot be on Medicare. Those are the requirements in order to qualify for a health savings account. Money in HSAs are not lost at the end of the year, but carried over until spent for as long as you live. Do not confuse an HSA with the notorious FSA. Depending on your age, you can contribute over $3,000 or $4,000 to an HSA each year. And remember, contributions are tax deductible, which reduces your tax burden. HSA contribution limits are now increasing each year to account for inflation. People that are aged 55 and older and meet the qualifications can contribute an additional $1,000 to their HSA. You can use money from HSAs to buy over-the-counter medicine, family planning products, etc. Moving on to Dave Ramsay's 7 baby steps. I believe this provides a good plan for people to map their financial strategy. The first step is to save $1,000 for an emergency fund. However, Mr. Elliott suggests you save $2,000 for that starter emergency fund due to inflation that has occurred over the years. Number 2, pay off all debt except your home using the debt snowball. The debt snowball is a concept which means you start with small debt balances first and move to bigger debt balances. As you pay off those debts, you're freeing up cash flow from paying off debts. You can use the newly freed up money to accelerate paying off other debts. After your debt is paid off, the third baby step is saving 3 to 6 months of expenses in a fully funded emergency fund. Notice, it is not saying 3 to 6 months of income, but expenses. Once you have completed that, you start investing 15% of your income into retirement accounts. This may be higher when adapted for your personal early retirement plan, if you so choose. Once you have reached the 15% point, and if you have extra money, then you move to step 5, which is a saving for your children's college fund. If you're unable to save for your children's college fund, you should not feel bad about that. Your kids can work to help pay for their own college. Next, you pay off your home as early as possible. And lastly, you build wealth and give. Here is Dave Elliott's more detailed interpretation of Mr. Ramsay's baby steps. How it should work. This is very important. Once your emergency fund is funded, then you start paying off debts. However, if an emergency comes up, you stop the additional money to paying off debts and you go back to funding your emergency fund. Once that emergency fund is refunded, then you start paying off your debt again. Then you move on to your 3 to 6 months of income emergency fund. Then once you've completed that, you start saving 15% of your income for retirement. If you have an emergency, then you stop that 15% to retirement and you move back until your 3 to 6 months emergency savings is replenished. Beyond that, you are still saving 15% for retirement, and if you have additional money above that 15%, then you can save for your kids' college, etc. But the point here is that once you get to that point where you're saving 15% of your income for retirement, you're always doing that unless, of course, you have an emergency that puts you back on another step. Listen carefully. You do not stop saving 15% of your income for your own retirement to fund your kids' college or paying off your home, etc. This is very important. Once you get to the point of saving for your retirement, you never stop saving for retirement unless you have an emergency. The reason is because when you retire, the Social Security Administration will not provide you with 100% income replacement. As of 2025, Social Security retirement benefits are approximately only 37% of your income. This is likely to decrease over the years. Therefore, saving for retirement is critical. Now, let's talk briefly about envelope budgeting. This is just a method of budgeting that you might consider. You can do this with actual cash, or you can do this in virtual envelopes within an app. Here's a summary of the concept. When you receive income, you allocate money, you spread that money around to different envelopes, and once those envelopes are funded, they provide limitations on your spending. And of course, if you need to adjust how much money goes into those envelopes due to inflation, extra costs, unforeseen events, etc., you get to control that. Nevertheless, it does help you provide limits and control on your spending habits. And here are a list of budgeting apps that you might consider. TheGoodBudget.com, Segbay Software has an envelope budgeting app called Budget Manager. There is one in the Apple App Store called InV Envelope Budget. Please note that we have not yet tested these apps. Next, let's discuss some dirty tricks which the credit card companies can sometimes play on us. You will need to pay very close attention to your credit card statements. Now look closely. Here on the left, you can see in May of 2022, the minimum payment was made of $253. If you look lower in the green box, you can see the balance remaining at $9,264.12. Now, follow the green box to the right side and look across to the next month in the green box, categorized as purchases. The balance shows $9,121.64. So, we can see that payment did reduce the balance owed. However, if you look in the red box called Cash Advances, back to the left side, which they have abbreviated as advances, look closely on the left side in the red box. The balance on advances was $1,720.82. Now, follow the red box to the right side to June in the same red box. The advances balance actually increased. So, what the credit card company is doing here is when you make only the minimum payment, they are applying that money only to purchases. And as you can see, the interest rate in this case for purchases is 14%. But they are not applying any funds to the cash advances, and that interest rate is over 25%. The reason the balance on advances increased is because they applied and added the interest charge to the advances balance. Remember, they are doing this when you only make the minimum payment. This is not clearly stated. It was necessary to call the credit card company and find out what was going on. I can't say if all credit card companies do this, but I urge everyone to pay very close attention to details in your credit card statements. Be sure to compare credit card statements to prior statements to look for unusual things. This concludes Part 2. Thank you for listening. Please stay tuned for Part 3.